Hello, in this lecture we'll take a look at Chapter 21, preparing a cost volume profit chart is where we are at. So we will first look at a cost volume profit chart, and it could look a little intimidating when we first look at it like this, but once we break it down, it's not too bad to look at, and we want to be able to basically identify the parts of it and see some key components of it in terms of what it can tell us. And so if we look at the vertical axis, we have the dollars. The horizontal axis, we have the volume, number of units produced. So then we're going to identify these lines here, and we're going to start with the fixed cost in this case. I'm going to start with this green line. That's going to be our fixed cost. If you look at it, it's doing what you would expect fixed cost to do if we think about it a bit. The fixed costs, remember, are things like the rent, which are going to be the same from period to period. So no matter how much production goes up, no matter how much the volume of production goes up on this side, we're paying the same dollar amount on this side. Therefore, the fixed cost is going to be a straight horizontal line, because as the volume goes up, if we produce more and more stuff, as sales goes up and up, it does not affect the rent that we have. The fixed cost will remain the same in that way. If we take a look at the sales on this line, that'll be the red line, then sales is going to go up by a constant amount. That amount will be, of course, the sales price. So if we sell units, then whatever the sales price times the unit will be a constant increase. So as units go up, then the sales price will go up in a constant rate. It's going to be a straight line that goes up forever in that relationship there. So that it'll start at 0, of course, because if we don't sell anything, it'll be 0, and then it will increase, and we can see, of course, where the sales will cover our fixed costs and where they will intersect here, which we'll talk about the total cost after this, and continue on indefinitely, theoretically, of course. And then we'll take a look at the total costs. So if we think about the total cost equals the fixed costs plus the variable costs. Therefore, it's going to start at the same point as the fixed costs do, because within total cost is fixed cost. So if we didn't sell anything, we would still have to pay the rent, meaning we're going to have the fixed costs and no variable costs. Then as we sell stuff, then the variable costs will go up at a constant rate, and we have no more fixed costs because they will remain constant. Therefore, we're going to start not at 0 because we have to pay the rent no matter what. We're going to start at whatever the fixed costs are at, and then we're going to go up at that constant rate, not of the sales rate. Notice that the slope of the line is not the same as the slope of the sales line, but we're going up at the constant rate of the variable costs. So we're going up at the rate of the variable costs, and we're looking for that. Of course, that intersection looks like a key point, and it is, because that is the break-even point. That is where the sales line equals the total cost line, where we are not making a profit, we're not losing money, we are breaking even at that point. Looks like it's about 880,000 in this case. Then if we continue up from there, if we take the area of the blue space at any given level of production, then that's basically our profit. So the profit will widen as we continue to produce and sell more. And if we look at the red area below, before we hit the break even, that's the loss we're going to have if we do not produce at production, at the break even. Therefore, many times if a company is doing a startup, then they may be down here in the loss area, and of course we hope to at some point get up here into the blue area and be analyzing our profits up top. We'll continue looking at this cost volume analysis in further detail in different ways, and notice that this is a budgetary tool. So cost volume profit analysis can help the owners of a company look at the data in such a way that they can then manipulate and predict and do some what-if analysis in a more standard way, a better way in many ways than a standard income statement would do, because of this breakout between the variable costs and the fixed cost. So computing income from sales and costs. So note that the traditional income statement is going to be the income minus the expenses, or income minus cost of goods sold gives us gross profits minus expenses. That is good for a static look at the income statement. But notice that if we think about that, within cost of goods sold, we have variable costs and we have fixed costs, and they behave differently. So when we think about budgeting, that's not usually the best way to look at it, because we don't know what's exactly going to happen in the future. And if I want to know what happens for different scenarios, then It's much easier for us to work those scenarios if we break out the costs in format of their behavior rather than trying to put everything within cost of goods sold that is related to cost of goods sold. So it makes sense to put everything in cost of goods sold that's related to cost of goods sold, including overhead and fixed costs, when we think about the total cost of a unit. But when we're trying to do a flexible budget analysis, then it makes sense for us to think about things not in terms of what is included in the cost of production so much as what are the variable costs that behave the same, what are the fixed costs that behave the same. And if we think about it in this format, we can think of the sales, which behave the same. If we sell units, they go up in a constant rate. We can think of the variable costs, which behave in a similar fashion in that they go up at a constant rate. And the difference between the sales and the variable costs we'll then call the contribution margin. So again, this is a managerial tool, the contribution margin. It's not on the normal income statement because normal income statement would be sales minus cost of goods sold or gross profit. We're doing a managerial tool here in order to put things together that act the same. And if we do that, then we can start thinking about, okay, if we make a sale in one unit, what are we walking away with after variable costs? That's going to be the contribution margin. And then we can think about, well, how many of those units may we have to sell in order to pay the fixed costs, like the rent? That would be a logical way to put the information together. If we look at a contribution margin income statement, we would have something like this: sales. This is total sales. We can also think about it in terms of units, but we're thinking about the total in this case would be 1,500 units times $100 each. That's our sales price. Therefore, we would earn $150,000. The variable costs go up in a similar fashion. So if we sold 1,500 units, it's going to go up at $70 each, or $105. Therefore, our contribution margin is $150, the sales price minus the variable costs, or the $45,000. Then, if we subtracted out the fixed costs after that, which stay the same at any level, at 24, that would give us our income of $21,000. Then, of course, whenever we think about income taxes, we always tack that on at the end because income taxes have a progressive rate and they often distort our analysis. So we are often going to have the same number here, the 21,000 before income taxes. Then we'll apply the rate of income taxes, in this case 25% of 21,000. 21,000 times 0.25 is 5,250. Therefore, after we pay taxes, we're going to have this 15,750. Okay, so then if we want to compute sales for a target income, then in this case we're going to compute it in units. So let's say that we're trying to find a target income. We just talked about how to find a break-even analysis, or if we've looked at how to find a break-even point. If we're trying to have a targeted income, then we want to think about it this way. We want to think about, okay, what are the fixed costs? What's the rent that we have to cover that's the same for each time period? And then we're just going to tack on to that, what's the added revenue that we expect to have? So the rent, the fixed cost plus the added revenue, we're going to divide that by, in this case, the contribution margin per unit. The contribution margin per unit, remember what the contribution margin is. It's the sales price minus the variable costs. So if we're talking about per unit, for each unit, we have the sales price minus the contribution margin per unit. And that will give us what we're walking away with after each sale of one unit over variable costs. So then if we do that, then we're saying that in this case it comes out to be $30, and then we're going to divide that into the fixed cost plus the target. That means that we would have to sell 1,200 units in order to both cover the fixed costs and hit our target. So you see, that's the type of analysis that we'll look at when we're trying to judge how well we're going to do, or what we need to do in the future. Now, if we wanted to convert this 1,200 units that we need to sell in order to clear the fixed costs and cover our target income, we could multiply that 1,002 times the sales price, or we can do the similar type of calculation to get the sales dollars, meaning we'll take the fixed costs plus the target income just as we did before, but we could just divide it by the contribution margin ratio. So the contribution margin, remember, is the sales. We can take it per unit or total. Let's take it per unit. sales per unit minus the variable cost per unit gives us the contribution margin per unit. If we take that contribution margin per unit and divide it by the original sales, then that's the contribution margin ratio. So if we take the same calculation and say the 24,000 plus the 12 divided by the contribution margin ratio, 0.3 or 30%, then we're going to have sales dollars of 120,000. Again, if you took that 120,000 and divided it by the unit cost or the unit sales price, you would come up to the sales units of 1,200 units to hit that fixed cost and the target income. So we could think about it this way. If we plug this into a contribution margin income statement, then we know what we want, because remember, we're budgeting to the future, and we're saying that we want to have a target income of 12,000, and we know that the fixed costs are, in this case, 24,000. So we could do analysis like this by just plugging it into our income statement formula for a contribution margin income statement, that is, and then we could back into the rest of the income statement. So what do we need to happen? What does our sales need to be in order to get to that bottom line that we are expecting or wanting of 12,000? Well, if this is the case, then this number minus this number equals the 12. Therefore, the 24 plus the 12 must be the contribution margin of 36,000. So that's how we'd get to the 36,000. And then we know that we have a unit contribution margin, remember, of 30%. How do we know that? Because it's the unit sales price minus the variable cost gives us the unit contribution margin. Unit contribution margin divided by the sales price gives us that 30%. So if we know this 36,000, then we could divide that by 30% or 0.3. That would give us the 120,000. And then of course the 120,000 minus something must be the 36,000. So the 120,000 minus the 36 gives us the difference of 84. 84 is what we need in order for the 120 minus the 84 to equal the 36. So now let's run some numbers in a calculator just to verify this for a bit. So remember, we had the 24 plus the 12. So with the 24,000 plus the 12,000 gives us this 36,000 here. And then from that 36, we took the 36,000 divided by 0.3. So we're taking the 36,000 divided by 0.3 to 36,000 divided by 0.3 gives us the 120. Then we took that 120 and subtracted it minus this 36 minus the 36,000 gives us that 84. Now we can back into some of these numbers and say, okay, where did that 0.3 come from? We got it from a per unit contribution margin, but if we take the total contribution margin, which is at 36, and we take 36,000 divided by the sales of the 120, that's our 0.3 or 30% if we move the decimal 2 places over. So that's our contribution margin. Now, if we're saying that we're getting 30% of sales in the contribution margin, 30% minus 100% is 70%. So if we take the 70% times the 120, we know that that's going to be the 84,000. That's the variable portion. The variable portion is therefore 70% if the contribution margin is 30%. So you can mess with those numbers and get more familiar with them by looking at some of the statements like this. So computing multiple break-even points, that's what we'll continue with next time. So you'll note that we've computed a break-even point as if we sold one product for one price. And of course, there's a question of, well, what if we have multiple products with multiple different prices? How can we do a similar calculation in terms of what would be the best mix